This has been an episode that I've long wanted to create since the creation of this podcast. Every living adult wants to participate in the economy with a goal to provide financial stability for themselves and for their families. The problem, however, is that many of the general populace haven't had the chance and the opportunity to learn and or to be taught how life really works, especially on financial literacy. Financial literacy is a core life skill for participating in modern society. But how many of us have been educated about money, the importance of budgeting and saving for a rainy day, how bank accounts and debts work, and when it makes sense to save for a pension? Oftentimes, it's when life hits us hard that we realize we have not financially prepared to tackle it. And this is mostly attributed to our financial illiteracy. Nelson Mandela once said, and I quote, "Education is the greatest engine of a personal development," end quote. And, I quote, "Education is the most powerful weapon which you can use to change the world." So for this episode, we want to focus on this fundamental core that impacts our lives, and it's a conversation that we need to have as a society, as a nation, and as a people, especially among the people of color. It's time to open up about money and finance. Firstly, I would like to preface that the content provided in this episode does not constitute as a financial advice. Neither am I qualified and or registered financial advisor. It is up to you, the listener, to do further research by consulting professional and qualified financial advisor, registered by the Financial Sector Control Authority, also known as the FSCA in South Africa. Now back to the episode. In South Africa, financial literacy is low. For those that don't know what financial literacy means, it simply means how to use your money wisely. Financial literacy helps you to understand how to save money, spend money, and how to make smart choices with your money. By being financially literate, you can make sure you have enough money to buy the things you need and want, and also have some left over to save for the future. I would like to emphasize that the definition of financial literacy was kindly contributed by this new AI platform that is trending right now called ChatGPT. With that being said, according to the CNBC article of 2022, 49% of South African population are financially illiterate, and approximately 5% of the population will retire comfortably. This is just on personal finance alone. To begin, once you qualify and are of legal age to enter into the working market, you will have to familiarize yourself very quickly with the financial services sector. The financial services sector is made up of industries and institutions that provide financial services to commercial and retail customers, aka you. These industries include banking, insurance, investments, consumer finance, mortgage, lending, such as home loans, etc. and etc. There are 5 industries that everyone needs to know and familiarize themselves, seeing that they play a vital role in your adult life. If you don't know any of these industries, you become a good customer to them, to the point that you can get extorted thinking that it's normal business practices. These industries include banking, investment, lending, including credit score, tax, and insurance. Let's get into the breakdown of these industries that we've mentioned above and have a look at what each industry provides, what we need to learn and understand should the time comes to apply for the product and services they have on offer. Industry number 1, banking. Now, we will focus on retail banking and not commercial banking. A bank is a financial institution which involves borrowing and lending money. When you have a bank account, you are a depositor. Your salary and money that you put in a bank are called deposits. The banks are regulated by law to keep a percentage of your money in a vault and grow the rest of your deposits. They do this by either investing your money in the market or lending it out to borrowers, the person to whom the bank lends the money. Depositors get their return through an annual interest payment, and the banks lend the depositors' money to borrowers at a higher annual interest. The difference between the two interests is the profit for the banks. Employers are obliged to pay their employees' wages either in cash or checks. For security and accountability, employers prefer paying their workers' wages directly into their bank account from recognized banks. Unfortunately, growing your money by depositing cash into the bank isn't worthwhile. This is because the interest rate the bank provides is below inflation, thus making your money lose its value. This brings me to the next industry. Number 2, investments. An investment is a process of acquiring, collecting assets, or committing money with the purpose of generating income in the future or appreciation. Appreciation refers to an increasing the value of your assets over time. Thus, the act of investing has a goal of generating income and increasing your value over time. Based on these definitions, investment or investing is a time-based game, meaning that it's a long-term game, not such get-rich-quick schemes that's floating around. The longer you keep your assets and money in an investment, the more time it has to build value, and the greater payoff you will earn in the future. Typical types of investment include owning stocks. That essentially means that you're loaning money to a company in order for the company to expand, grow, or invest in research. In return, you own stocks in a company and you are paid dividends from the net profit of the company. As the company becomes more successful and other investors seek to buy that company's stock, its value can also appreciate and be sold for capital gains. Other investments are index funds or unit trust or EFTs, or a collection of investment schemes. Others are properties or real estate. Others are commodities, such as owning precious metals such as gold. Cryptocurrencies, which I'm not going to discuss anyway. And collectibles such as timepieces, rare and unique vehicles, paintings, sneakers, etc. And finally, bonds. The key takeaways you have to consider when considering investment. An investment involves putting capital in an investment vehicle that generates future income, as I mentioned above. Investment does not come with guarantees of appreciation. It is possible to end with less than what you've started with. Case in point, those that invested in rug pulls in crypto. Investments does carry risk, and there are ways to reduce risk, such as diversification. In other words, not putting all your eggs in one basket. My financial advisor always gives me this one piece of advice. Do not work for your money. Let money work for you. Kevin O'Leary, aka Mr. Wonderful, once said, "Money doesn't have feelings, nor understands your emotions." What this simply means is that if you invest based on your emotions, you'll end up pulling out prematurely, or even lose your capital investments. Over time, I've learned that money isn't only made to be spent, but also to be invested. There should be 2 types and reasons for investment. One for short-term goals, as short-term investments, and the other for long-term goals, again for long-term investments. Essentially, there are a few things that you should put in place throughout your lifetime. 1. An emergency fund for emergency days, such as job loss or planning for a holiday. This fund is a fund that you can access immediately during an emergency. One must at least keep 1 year of net salary stored in this fund. Second, a long-term investment vehicle, whether it's a trust fund or a property investment, etc., which will be able to pay you income when you retire. Ideally, you want to invest as much as possible from an early age and let your asset grow over time and reap the rewards at the end of the day, or at your retirement year. There's one thing that we were never told as kids or as young adults: the importance of having credit, a credit score, and how it impacts you in the way of getting finance. Hence, the need to understand topic number 3, lending. Whether you are interested in owning a home, a vehicle, or anything that is of substantial value, unless you have the full cash amount for that purchase, you will need to apply for a finance from a reputable, licensed, and recognizable financial lender. According to Investopedia, a lender is an individual, a group, public or private, or a financial institution that makes funds available to a person or business with the expectation that the funds will be repaid. Repayment would include the payment of any interest or fees. Repayment may occur in increments, as in monthly mortgage payment, or as a lump sum. One of the largest loans consumers take out from lenders is a mortgage. With that definition, the person who gives you money on credit is a lender, and the person who is asking for money is a borrower. There are two types of lending: secure lending and unsecured lending. Secure lending is a credit that is backed by an asset, such as a home or vehicle, stock options, etc. Hence, it's called security. While unsecured lending requires no security, but do require that the borrower, which is you, be sufficiently creditworthy in the lender's eyes. It's also one of the reasons why secured loans generally has lower interest rate than unsecured loans, as it is less riskier than unsecured loans. Typical examples of unsecured loans are student loans, personal loans, credit cards, etc., while typical examples of secured loans include home loans and vehicle loans. In order for the lender to give you the fund that you've applied for, you need to qualify for the loan with a clear payoff plan, i.e. the financial institution wants to know whether you can afford to pay your credit for the duration of the life of the credit. If you are applying for an unsecured loan, because it is not backed with any security, the financial institution will require you to have a good credit score and a history of repaying past debts. A credit score is a number that depicts a consumer, which is you, creditworthiness. It is a prediction of your credit behavior, such as how likely you are to pay a loan on time, based on information on your credit report. There are various factors that affect your credit score. 1. Your payment history. By making payments on time on your credit account, it helps with your credit score. 2. Credit usage. 3. The length of credit history. 4. The type of account, to see whether you're managing all your credit account installments. 5. Recent credit activity, whether you've applied for new accounts recently. You do not have just one credit score. Each credit score depends on the data used to calculate it, and it may differ depending on the scoring model, which itself may depend on the type of loan product the score will be used for, the source of the data used, and even the day when it was calculated. Lenders view low credit as a sign of risk, so an applicant with a poor or fake credit will pay more in interest to borrow a loan. Usually, a higher credit score makes it easier to qualify for a loan and may result in a better interest rate or loan terms. Your credit history, collected from lenders and various credit providers, are stored at the credit bureaus. In South Africa, we have various credit bureaus to get your credit report. The primary dominant ones being Experian, TransUnion, Vericred, and Expert Decision System, also known as XDS. Honorable mentions include Equifax and Consumer Profile Bureaus. Financial institutions or credit providers liaise with these prominent credit bureaus in order to understand your credit history and build a credit profile of you, with the addition of their own algorithm, of course, with a credit score model to ascertain your credit risk profile. Unfortunately, not having a credit score isn't necessarily bad, but it's not ideal. It can prevent you from qualifying for loans, credit cards, and housing, or complicate your ability to rent cars against cell phones or cable subscriptions. So it's basically anything that you can take on credit. People who do not have any credit history are known as credit invisible. Thus, your credit reports records your history of borrowing money and repaying debt, and a credit score is calculated using data recorded in one of your credit records. So, the importance of knowing your credit score. How do you know if your credit score is rated as good or bad in the eyes of financial institutions? There are a vast number of online vendors who offer the service of being able to check your credit score for free. For starters, all the major credit bureaus provide free credit reports once a year for every consumer by registering on their site or requesting a free credit report. Other notable service providers in South Africa include ClearScore, MyCreditCheck, and Kudo. Generally, a score between 670 and 850 is considered good. The higher the number, the better it is for the consumer. This highlights to the service provider that you can manage your credit and pay it in a reasonable time. If you're one of those who are classified as credit invisible, and you can produce 3 months bank statements as proof of having 3 months of income. Get a credit card from your nearest bank. Start transacting using your credit card. Learn to manage your credit spend and repay your credit card on time. Building your credit score takes time, and the sooner you start, the better. In order for not making this content too long and boring, we'll pause here for a brief moment. In the next episode, we will explore the importance of tax, why you can never avoid it, and also the insurance industry, and why it's crucial to insure your assets no matter what. My name is Bohaki Cindy. If you listened up to this far, please feel free to reach out on my socials and come say hi. It will be awesome to communicate with you and all be friends. Thank you for listening and for lending me your ears. Until the next episode, God bless.